April 2nd, Liberation Day, and say, would the U.S. economy, would we have expected it to be in this great shape? Probably not. So does that continue, or is the tariff hit simply delayed? That's the first thing. And secondly, how do people at the central banks like the Fed react? So right now, I'll give you an example. The market expects the Fed to ease about 100 basis points more, putting the funds rate down to about 3%. Does Powell endorse that idea today? Does the Fed really follow through in the next few months? These are the big things people need to weigh over the next, call it, 6 to 12 months.
All right, Ross, from an equities perspective, how much is the rate picture necessary for the next leg hypothetically higher in the marketplace?
Look, I think it's a leg that the bull market stands on, but it's not the main one, right? We know the AI trade is primarily fueling this. Now, there is a lot of easing baked into the market. So I think on one hand, the idea of lower interest rates sparking some of the cyclical corners of the market, the housing trade, for instance, is important, but it's also baked into the market. I mean, we look at Fed fund futures, and again, 100, 125 basis points more of easing, plus the end of QT, which is more, easing of financial conditions. So it's clearly a big part of this. We don't have a lot of data points, but Fed rate cuts plus no recession has been a very potent mix throughout history. And I think we're sitting there today, but it's far second to AI and the developments on the front of the Mag 7 and some of the other players in that space.
And Ross, how important is that balance sheet policy or clarification on policy going to be for those equity markets?
Maybe important on the margins. I do think, if Powell were to come out and surprise the market by saying that we're just going to keep letting the balance sheet run and continue quantitative tightening into perpetuity, I think it might be a bit of a shock to equity markets. We've seen some stress in short-term funding markets. I think that's actually the impetus for Powell to maybe pull this QT end forward into today. But if we're looking out long-term as to what matters, I think in addition to tariffs and to how the Federal Reserve reaction function works, we're looking at inflation. I mean, we've seen inflation come down, but we've also seen inflation.
What is going on, guys? What is going on? All right, that should be better. What is going on, guys? So Fed announcement coming up in 13 minutes. Likely going to be a 25 basis point rate cut. We want to hear what Jerome Powell has to say with regards to quantitative tightening. So expecting him to, I think the market is expecting him to pause quantitative tightening. And there could be, I think, excuse me, guys. I think the rate cut is priced in, obviously. But I think the quantitative tightening is not fully priced in. So I think that there could be either a shock or a pleasant surprise, depending on what he does with that. Always the same annoying questions. Every single FOMC. Are we going to go down or up? Guys, both. It's going to happen in both directions. There's going to be a manipulative move, and there's going to be a counter move. And sometimes there's a counter to the counter. So, 2 p.m. is when when they're going to release. Then there is a half an hour period between 2 p.m. and 2:30. Then Powell will give his remarks at 2:30. Right? So at 2 p.m., you're going to see the manipulative move. At 2:30, you'll see another move. And then sometimes there's a counter to that move at 3. Now, if we're looking at gamma exposure here on the S&P 500, right? And this is where dealers are hedged. This is what gamma exposure is. You can see that there's a ceiling at around 69.30-ish, right? We do have some strikes above here, obviously, but this is for today's expiration. You can see there's a ceiling on the S&P 500 at 69.30, and there's a floor at about 68.55.
5 seconds away from the big Fed rate decision. Let's get some final thoughts. And Barbara, we're going to start with you here. What exactly would you be watching for, mostly from the press conference at this point?
For the Fed, well, we obviously want to hear what he's thinking for the future. Everybody's expecting the 25 bips cut, but we'll see what he thinks in terms of December and what he thinks in terms of inflation and labor. Those are the 2 key things. And so lots going to key off that in terms of where we go. I think for now, the AI play is strong. You've got huge consumer spending, some 40 to 50 trillion, and wealth has been created since 2019. So next year looks good. So I'm not even so sure we need to have clarity on how many rate cuts for next year, given because I think earnings look very strong and the guidance has been very strong.
Tim, what do you think?
Well, and I think the lack of clarity gives the Fed an ability. I mean, Powell could actually really punt on December language. And it doesn't mean he won't give some guide, but my inclination is if you've got a 90% priced in on December, I think there's the risk that you could be disappointing people. I think over the next couple of days, I think bond markets and rates could give a little something.
All right. So if you take a look at where we are intraday on the S&P 500, you can see that 6850 level is where the new week opening gap was, right? So this right here is Friday. This is Monday. This is that gap, this new week opening gap. I would not be surprised, I'll be honest, if we get a move down on the S&P 500 to fill the new week opening gap. And then remember, tonight we have Mag 7 earnings, and Thursday we have Mag 7 earnings. So I think what could happen, I would like to sweep this high, by the way. I would like to sweep today's high on the S&P 500. And I would like to see a manipulation down to the new week opening gap. Maybe a continuation on Thursday, and then Friday rally after all the earnings are out. That's what I'm thinking about. So if we take a look at, and we're about 7 minutes away from the Fed decision, which is going to be a 25 basis point cut. That's not a surprise. But we are going to be waiting on Powell to give us some more heads up into December, as well as quantitative tightening. So tonight we have Meta, Microsoft, Alphabet. Tomorrow night we have Amazon and Apple. Obviously, all these other companies too. Another thing to note is that the breadth yesterday was horrible. So the S&P 500 made a new high yesterday, but more than 80% of the S&P 500 stocks were down. That's what you call negative breadth. So what I really want to see at 2 p.m., I want to see one of these, NQ or ES, take out the high. and then potentially manipulate lower. I wonder if we can get here.
Our lunch. I'm Dominic Chu in for Brian Sullivan today. We are just about, call it less than 5 minutes away until that very key Fed rate.
They keep saying breaking news as if they're going to report it early or something. And every time they say breaking news, this clown jumps on and says, we're 7 minutes away. We're 5 minutes away. It's not breaking news. We know what time the Fed decision is. And in terms of stocks today, obviously it's FOMC. Everything should be taken with a grain of salt. But our ASML position is like $20 away from all-time high. This has been one of the best stocks to be in the last year. We bought this in the 600s and are very close to doubling our money on this. NVIDIA continuing its rocket here above 207. Palantir, new all-time high. Tesla's just flat. Had a really nice trade on Tesla yesterday, but I think Tesla, wait, yeah, that's where we broke out of. We are flagging here, and I would like to see Tesla head towards 490. Just need to get away from the volatility today. If we get a vol spike, well, actually, I'm not going to say that. I was going to say if we get a vol spike, it might be an easy short on volatility. But then I forget that we're also reporting Mag 7 earnings tonight and tomorrow. So I'm going to do away with that idea. All right, Fed decision in 2 minutes.
You're right.
I'll be right back. I'm going to keep this on 1 second.
Closer to 5 more rate cuts in front of them.
All right. Now, Francis, if we turn towards you, there have been allusions now from both of our guests here on the panel with regard to kind of what other data points might be at play. From your standpoint, what were you looking at over the course of the last few weeks in the absence of any official government data coming out, ex the CPI print we got last week?
Quantitative data from the private sector and also some qualitative data from the beige book, but that's exactly what I want to hear from Powell today is we have a sense of what their decision-making function is, but what are they going to be reacting to? Because this isn't just about 1 month of lost data. We're going to have several months here where the data is going to be very skewed, very difficult to get a core read, especially on the inflation side. That's really hard to look backwards on and tell us where we were 3 months ago. So I want to hear from Powell today. This is what we're going to be looking at, not just how we're going to be reacting to the economy ahead.
Now, Francis, one quick point here before we get to that decision. From a data standpoint, do you feel constructive about what the economy is doing right now as we head into this print?
No, this is what we call stagflation light type of environment. It is growth below comfort level, and it is certainly inflation above comfort level. I don't know what the Fed's trying to achieve with these rate.
Someone's asking, thoughts on shorting Palantir with the current rate cuts news? Guys, you really have to get out of this mindset, man. You really have to get out of this mindset that what's going to go up, I'm going to short it because it's at all-time highs. That's going to break you. All right, here we go.
Interest rates by a quarter point to a new range of 3.75 to 4%. There were two dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Smith, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into T-bills. It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators. One of two nods in the statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cutting by a quarter, two dissents on both sides of the issue. One wanted more, one wanted none at all, and the Fed stopping quantitative tightening as of December. Guys?
All right, Steve Leisman, please stick around here. Let's get back to our panel for some reaction here. Jim, I'm going to start with you first. We showed the charts of the market reaction. Equity markets have been relatively stable as they were going into this print. The curve from the 2-year all the way to the 30 have moved maybe higher by anywhere from what I could see 1 to 3 basis points. This is all about the Fed rate press conference now at this point. But what stood out to you from hearing what you heard from Steve and then what you saw or didn't see from the market reaction?
So that's a great question. So I think that we are in the sweet spot of policy uncertainty for markets. And what I mean by that is that we're expecting there to be better growth in 2026. But at the same time, we're also expecting the Fed to cut interest rates. So you may have higher growth. You may have a labor market which is keeping wage inflation and wages relatively, stable, which keeps profit margins high for companies. And again, better growth, lower rates, you're discounting those future cash flows at a lower rate, you're increasing the present value.
Man, that would have insta-printed. I should have had my order set up right here. So the Fed cut rates by a quarter as expected, and they said that they're going to stop quantitative tightening in December. So already announced that they're going to stop quantitative tightening in December. What's interesting is that they said multiple times that because we don't have data, because the government is shut down, that they're working with limited data. But it's crazy that they actually then made two big decisions citing the lack of data. That to me makes no sense. That to me makes no sense whatsoever. They kept saying, and we'll hear Jerome Powell talk about it and answer questions from reporters, but they kept saying that there's no data, there's limited jobs data and limited economic data, but then they went ahead and made two huge decisions. Really doesn't make sense to me. So they're going to be on Powell's ass, the reporters that is, getting him to explain the Fed's rationale there. But there were two dissenters within the Fed. One dissenter wanting no rate cuts and one dissenter wanting more rate cuts. So go figure.
Moved up. And that's okay for right now because the unemployment rate hasn't broken out. The bottom hasn't fallen out. And inflation, while I would say is still too high, is not up at that 4 handle. But one of these sides of this stagflation environment is going to break, and the Fed is not going to have the same luxury middle of 2026 as it does now to play both sides of that. And even in the dissent, you can see we're getting dissent on both sides of the mandate right now. That's a real call out to that. This equilibrium that we're in, it's not going to last forever. Our view is that inflation is going to turn out to be the real problem, and heading into 2026, this Fed is not going to have the ability to point to the job market to the same extent as they have now. They're going to have to slow down here when they see inflation rising further into Q1.
Francis, at multiple points over the past few months, we've heard Fed Chair Jerome Powell make public statements to the effect or the tune of that there is no risk-free path going forward with regard to inflation.
So we got the manipulative move up into that area I was targeting. And I think the extent of this drop, this first drop, will be likely Asia low. Not a whole lot of reaction here from individual stocks, to be honest. Nvidia still up 3%. Tesla still flat. TSM still up 1.5%. CoreWeave up 2%. Now, there isn't a ton of change here individually. Amazon's still flat, but it reports later. Let me look at gold real quick. What the hell? Look at this barbell on gold. Gold mitigated this 4-hour fair value gap. And in general, I think the metals... Well, let me look at silver real quick. And I'll get to your questions in a second.
For the market, I did note that the probability of a December cut is still very high, but it's not for January. January was still around 45% last I checked. One other thing is, well, I'll leave it there, Dom.
All right. A quick couple final thoughts from you guys. David, for you first.
Well, I think overall it does bring into question whether the Fed cuts quite as aggressively going forward. But you know, for investors, I think the economy looks fine. It's not really, to me, a matter of the economy. I don't feel that the Fed needs to be cutting quite so aggressively, given where the market is right now.
Jim?
All right, let me get to your questions before Powell starts talking. Best price to buy physical gold. I think you missed the boat. Long or shorts? Both. Why does Forex fat? I don't know. Hi from Dubai. What's going on? All right, guys. Sign up before we get into the Fed meeting. I'm doing a live 2-day trading accelerator. You have to sign up. It's free, but you have to sign up to get access to it. First day is going to be options. Second day is going to be futures. If you wanted to take your trading to the next level to start off 2026 right, and you're sick of doing the same thing, make sure you register. It's going to be hours a day, and it's absolutely free. If you're watching this on X, it's in the reply to this feed. If you're watching this on YouTube, it's the pinned chat. So far, a little bit of dislocation here between NQ and ES. Gold and silver just barbelling here. I want to see data highs get taken, which is that wick right there on NQ and ES. Yeah, but the Fed is acting really weird here. They claim that inflation is going up, which it is. They claim that they don't have economic data because they don't, and yet they're still making these insane sweeping decisions here. Crazy. I want to see data high get taken on NQ or ES first. There's a lot of nonstop chatter about iron. We already took most of our profits on there 2 days ago. In this market, you guys have to trim, in my opinion. Oddly enough, we're seeing a rally in yields that I think is also manipulative here. But this is the 10-year yield back up above 4%. So because we're seeing a rally in yields, likely that's going to translate over to the dollar, which it is, which is going to translate into interim weakness for gold. But I think that that dynamic reverses in a second. That short from there was would have been so fire, dude. Yeah, I want NQ or ES to take data high, which is the 2 p.m. high. Yeah, I think we tagged that high. I wonder if there's a scalp to be taken there. There's just not enough, honestly. Let's see. It's about a 1.5 to 1 trade. I think we go for 2 p.m. high, guys. I would have to target higher than 2 p.m. high. I do not like this risk reward. Maybe here? I'm going to try this here. Yeah, it's the only way I'm getting a 2-to-1 risk reward. Is if I take it on that retracement. We have bearish divergence here. We have bearish divergence here. Fuck. I should have seen that. I may get out near break even here. Yeah, I don't want to take a full stop here. I should have seen that bearish divergence coming. I think this will sweep one more time first. Maybe I'll wait until Jerome Powell says good afternoon. But yeah, the big stocks largely unchanged here. Nothing is moving individually. Um, 7 minutes until Powell, guys. Gold isn't moving either. So far, pretty shit FOMC, if you ask me. I don't think it stays that way. I think we will get some movement once Powell starts talking. Don't close, hold. I don't want to take a full stop limit here. You can hold it if you like. What do you think about gold? Nice. Gold looks nice. Thoughts on rate cuts? Cool and expected. What time does Powell speak? My mom wants to know. I already told your mom. She's right here. She's sitting right there. Don't worry about her. I already told her. Can you tell my mom too? Damn, bro. Jerome in 4 minutes, guys. As gold trades below 4,000. Wow, the market really hasn't moved today. What futures trading platform am I using with TradingView? TraderVate.
We'll have to watch. Here comes Powell.
Okay. No, we're going to wait just one moment here. Steve, we are waiting, as you can see here in the image, waiting for Fed Chairman Jerome Powell to take the podium. We've got roughly, call it maybe a minute 45. He's very prompt, by the way, Jerome Powell, stepping up to those podiums right now. So in the minute and 25 or 30 seconds that we have left, Steve, I'll give you a final word here. What exactly would you be wanting to listen for right now out of this press conference?
So I think a lot of these press conferences are checking the box, right? So Chair Powell is very good at playing it down straight down the middle of the fairway. I don't think he's going to tip his hand. I think he's going to say this was an insurance cut, and those will be the next insurance cuts based on trying to save the jobs market. I will leave you with this, and then I'll let Richard close it out. If you feel like the Fed is on time in making decisions, they're late. On time is late in the Fed policy world due to the long and variable lags. So if it feels early to you to be cutting rates, he's probably on time.
All right, so we've got a little balance here. Richard, I'll give you the final word. Your final thoughts before Fed Chair Jerome Powell takes the podium.
Remember, monetary policy, we used to think that it would take 18 months to have its impact. I think the period's much shorter now, but there is a variable rate of time that it takes for these decisions to actually hit the economy. The markets react almost instantaneously, right or wrong. But I thought that was a very good point. And we're just going to have to see how he handles himself here and what he says. And I expect him to be cautious. And the last thing I'll say is this. No Fed chairman has communicated this constantly with the marketplace. Remember, Volcker said nothing. Greenspan talked, but we couldn't understand what he was saying. He was just a great mumbler. And it was only every quarter that you might have gotten, or sometimes only twice a year, from previous chairman. Let's give Jay Powell credit. After every single meeting he meets, he also is open when he talks. And I think that's very important.
I'm telling you, he's prompt. Richard Fisher, I want to cut you off right now. Fed Chair Jerome Powell is taking the podium as we speak.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there
Oh, fuck.
Strongly differing views about how to proceed is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. You know, we've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing.
So right after Powell said that he doesn't see December cuts being a foregone conclusion, we saw that drop. We did not take data high yet. This right here looks like a power of 3. Like I said, I think we are going to head down to that gap on ES, also supported by the fact that we do have some support at 68.50 here, right? Which on SPX, 68.50 is around where we are right now on ES because it's not a one-to-one. So I do expect to see a move up potentially to take out that 2 p.m. high. I really would have liked to tag this new week opening gap down here. We did get close enough. NQ is a lot stronger. And I think there's a potential long scalp on gold. Now that we tagged Asia low.
Does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what... In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually.
I think we go higher
I don't
here
think
to
you'll
take
notice
out
it
that
in market
2 p.m.
conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or
Man,
inflation?
I almost want to trade options here.
So, okay, so the September CPI
As I don't think I'll
report,
get an
we
entry
didn't
on
get
futures
PPI
just yet.
after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI,
But I
there
think
might
one
be
of them tags
some
that 2
adjustments.
p.m.
But-
high.
So directionally, you know,
This right
it was a
here,
little
this is
softer
the
than expected,
manipulation.
and we always break it
We
down
were
into the three
consolidating.
components. So
That's the manipulative
basically,
move.
you've
And we
seen
likely go
goods
back up to
prices
take that 2 p.m.
increasing,
high.
and that's really due to tariffs. And that's compared to a longer run trend of very, very
By the way,
mild
the fact that
deflation
Tesla
in
is just
goods.
chilling
So
here
that's moving inflation up.
and hasn't
On
really
the other
moved,
side of that,
I think
good
Tesla's
news,
good
that
for a long
housing services inflation has been coming down and is
multi-day.
expected to continue to come down. So
Like, if you
remember,
look at Tesla,
a year,
right,
a couple of
this
years
is
ago,
just a-
that's the one that just we kept.
Sorry, guys. If you look at Tesla, this is just a flag here. We popped out of the flag, but the fact that we're sitting above all these highs and Tesla hasn't really moved, regardless of the fuckery today, this gives me more bullish impetus or a more bullish bias, sorry, for Tesla to tag those all-time highs soon. So if you look at these equal highs here, I still like Tesla calls here. Multi-day, not today, but multi-day calls to get to that 480, 490 level. That's a really good, that's a very bullish sign here that Tesla's maintaining regardless of what FOMC is doing.
in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation. Yeah. Well, again, the part of services inflation that is that isn't coming down as we would like it to is the non-market part of non-housing services. And, you know, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and I mean, financial services that are imputed rather than actually paid is a big part of that. But also just, you know, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, you know, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or a similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that. And so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Liz Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration, and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off as real.
All right, guys. So it looks like that, as a matter of fact, was the manipulative move, and I'm looking for a move back up towards that 2 p.m. high. It looks like we bounced off of that on SPX. If you look, it looks like we bounced off of that 68.50 level, and there is the next biggest gamma exposure is at 69.15 on SPX, which would on SPX put us around whatever the 10:30 a.m. high was. So on ES, you're talking about around 69.46. So that's why I was interested in a long here. Now, obviously, that's not guaranteed just because you have gamma there, but based on where we bounced from, where we manipulated to, I still would have liked ES to tag that new week opening gap. The fact that it didn't makes this still a little precarious, but Again, this is when the Fed's announcement was released. Then Jerome talks. So this is likely the move back up. So I want to take profits at that 2 p.m. At that 2 p.m. high, or close to that 2 p.m. high. But we are seeing a bit of weakness here. I could put my stop to break even, which I guess makes sense. Because if it did come back down, would I really want to take it again? I want to see strength in this move back up. I want to see strength in this move up. And you know, there are Mag 7 earnings tonight. So I don't want to sell call spreads, to be honest. With that said, if we didn't have Mag 7 earnings tonight, then if we do get to that 2 p.m. high, I would sell call spreads expiring tomorrow. Why are you trading through toss? Why not? What time frame is this? This chart here is 5 minutes. I'm still a little suspicious that we did not take this gap. So I can easily see a move here where we reject off this. If you take a look at just zoom out a bit, where we reject off this to come down to this gap before addressing the 2 p.m. highs tomorrow or Thursday. That can still happen. Because look at how untouched this is. We manipulated down, but we did not come into this gap. Flip side, we manipulate, take 2 p.m., and then tomorrow we see a continuation down. Does the gap need to be filled? Nothing needs to happen. It's the market. I think there might be a long on gold too. I might have missed my entry. I'm already in long gold. Nice. Another gap from Friday. What are you talking about here? That is Friday. This is Friday to Monday. That's the one I'm referencing. If you're talking about Thursday, Friday, yeah, that's another one. But I want to see a manipulation up, obviously, before the day's over. A manipulative move back up. And I'm okay breaking even here. NQ does look a little stronger than ES. But yeah, Tesla to me looks super strong. This is one that I might take for tomorrow. I already do have calls that we took half out on yesterday. I might add to these Tesla calls, to those same ones that I took yesterday with the group. Boo. This could still play. Do I really want to take it with 40 minutes left? Not really. Not really. But I do like Tesla here.
It's a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to
man. Yeah, I bet you this trade plays out to that 2 p.m. high. I don't know. I just, to be honest, I for some reason don't feel like continuing to get back in it. I think as the day ends, like you will see it get up there. Not that great of an FOMC for me personally. For the group, it's been amazing. They caught that short on the way down. So shout out to Justin. But for me personally, I've had better FOMCs like that. I don't know. Wasn't really feeling the price action here, but this to me on Tesla looks really strong. So that's, oh, you know what I want to look at with you guys is earnings. So, and for those of you that are just joining now, we are doing a live 2-day trading accelerator for futures and options. You have to register. It's free, but you have to register to get the info to join. It's if you're on Twitter or X, it's the reply to this. If you're on YouTube, it's the pinned chat comment in the chat. Yeah, earnings. Let me see something real quick. So Meta, Microsoft, Alphabet today, right? So Meta beats the expected move 50% of the time. Microsoft 50% of the time as well. What'd I say? Microsoft, Meta, and what? Alphabet. So Alphabet only beats expected move 42% of the time. Not enough to trade these, to be honest. You need something that is asymmetrical. Like Apple, only beats expected move 33% of the time. So tomorrow might do an iron condor on Apple. And Amazon, same thing, 33% of the time. It beats the expected move. So an iron condor on Amazon might be it as well. Now, yeah, I'm glad I'm not trading this. From a, damn, gold would have just hit that 2-to-1 TP. It might have ticked me though. It missed it by a tick. Who knows if I would have been quick enough to catch that. Best case scenario would be a muted move on Amazon. Because if we get a muted move on Amazon, then I think it sets up an easy long to all-time highs to the end of the year. And same thing with Meta. If we get a muted move on Meta, same thing. I think this sets up. Now, you might be asking, why don't you just long it now? Well, because before earnings, IV is juiced to the tits. So what that means is calls are expensive. After earnings, especially if the stock doesn't move, IV tanks, which means the price of options tank. And that's when you want to buy calls. Yeah. So the only thing I'm doing here is doubling up on Tesla. I could have booked like 600 per contract on ES. But I wasn't really in it to scalp. And we're going to get to a point where crypto is just coiling so much here that it's going to fucking explode come winter. This might last another month. Nice push on CoreWeave here. I think it continues to inch higher. You can see that the VIX has gone up, and even after the Fed's announcement, hasn't really dropped. And it's because of the comments by Powell saying that the December cut is not a guarantee. Palantir, sell or hold? No idea who you are. Oh, maybe my screen did freeze. Why did it freeze like that? My OBS froze. What the fuck? Why did it freeze like that? God damn it. My screen froze. One second while I troubleshoot this. What the fuck? That should work. For now, that should work. I'm not entirely sure why that happened. Bro running on Windows 7? It's a Mac, dumb shit. Same one I bought your mother for Valentine's. Which reminds me, next Valentine's, I should upgrade her to the space gray one. All right. Yeah, what I was saying was the only thing that looks good to me here is a Tesla swing trade. But VIX is increasing because of what Powell said. Now, I wonder if this changed the trajectory of the Fed funds futures here for December. No, still. Oh, wait a minute. Hold on. This makes no sense. Yeah, so a day ago, it was 91% certainty that the Fed was going to cut. Now it's only 60. I still think the Fed will cut. But it all really depends on whether the government is going to be open by that time. I'm glad I did not stay in this long. I do think we are going to touch that weekly gap below. So the only thing with regards to earnings that I'm looking at, like I said, is a muted move on Meta and a muted move on Amazon. And then I will likely take calls for the end of the year on both of those. This may be, honestly, this may be a good short on the VIX for tomorrow. Like the VIX is up 6%. Not a big pop on UVIXY. UVIXY is only up 2%. Man, what a shit FOMC. I think IREN looks good here too. But I'm already in a runner's position on IREN. Do I want to add to this? Could add back to IREN after taking profits. Let me look at something. These are coming in late. But we got to check if the open interest increases by the amount of the volume. I mean, this setup looks okay here on IREN, to be honest. It all just depends on how much you're risked. You are in for risk already, and how much risk you want to take on here. But I don't like that ES or NQ didn't take that weekly gap, which means there's still a chance it does it tomorrow. But I wonder if we get a last second pop on NQ to take out that 2 p.m. I was hoping that we would get up here on silver because I wanted to establish another short. Unfortunately, we didn't. Google is so strong, man. Google, ASML, AMD. Portfolio is going crazy because of those stocks. Nvidia, obviously. Yeah, I think CoreWeave looks bullish. Might make a run once again for the 150s in the next couple days. Iron looks like a decent pullback here. And Tesla looks bullish to me. All right, guys. Make sure that you sign up for the free 2-day accelerator. Link is in the first comment in the chat, in the first chat comment. If you're on X, it's in the reply. You will not be able to watch this if you are not signed up, so make sure that you register for that. Yeah, so the Fed cut by 25 basis points, said that they're going to stop quantitative tightening in December, but also left it open and said that, hey, the rate cut in December is not a foregone conclusion, so don't expect that. Earnings tonight, Mag 7 earnings tonight, Mag 7 earnings tomorrow night. If we get a muted move on Amazon and Meta, I think that's an easy long for end of the year. And if you're in the Discord, I'll see you in a bit. We got 15 minutes left. Otherwise, peace. Thank you, guys.